welcome. Welcome. We're so glad you're choosing to lean in on this conversation, this three-way conversation we're going to be having today with a very special guest expert who specializes in tax and estate, taxes and estate law. And he joins us with Equitable Life of Canada. And we're so excited that number one, you said yes, and that our listeners are going to be getting so much value from just your life experience in your professional career that will potentially help them, start planning and strategizing for a better future and also like just a better future.
Well, thanks, Winnie. Thanks, Lacey. Nice to be on. And hopefully I can provide some useful information throughout this.
Yeah. Can you maybe just to start off, could you share a little bit about your overall, professional career, and it'll give them everyone a little bit of context.
Absolutely. I'm a lawyer by training. I worked 11 years at an accounting firm dealing in the tax and estate planning area for business owners primarily. I then worked at a law firm for a couple of years where I did tax and estate planning, including drafting wills, drafting trusts, but also planning. And after that, I ended up joining the life insurance industry and working with advisors who are dealing with business owners and high net worth individuals.
And so how did you manage to keep your youthful looks about you?
I'm sure it's Zoom that's making me look younger than I am right now. But I've been lucky. I've worked with some phenomenal people over the years, so it's made my life a lot easier than having to learn all this stuff from scratch.
Yes. You know what they say? It's the same thing. Like both Lacey and I wouldn't be here today if we didn't have an opportunity to learn with some greats in the industry as well. So that always makes a huge difference for sure. Yeah. Well, that's definitely a mouthful. Could I call you like a lawyer and an accountant then?
I'm a lawyer and I did do a business degree, but I never did not go get a professional accounting designation. But I have worked with we're working with an accounting firm. I basically know a lot of the accounting stuff that ends up happening, at least from a tax perspective.
Yeah. Well, that's a lot of time spent in both worlds. So that's phenomenal. Okay. So from that perspective, as you know, the audience that we're speaking to today is really one of agricultural community, both farmers and ranchers for Canadians. And so one of the things that just to really start off with that I think is most likely top of mind that happened just, really recently as a CRA change is a lot to do with the capital gains tax. And getting a clear answer is sometimes a little bit difficult. Even when I approached my accountant, he was just saying like, it's hard. I mean, I think with that change, it's not necessarily black and white. So I'm wondering from your perspective, what the capital gains tax change really has, what the impact is for Canadians, especially agricultural folks.
So I guess first and foremost is right now the legislation, it hasn't formally been passed, but it's been introduced and, probably will likely be supported by at least one or two of the other parties on it. And so what it does generally, it says for an individual, the first 250,000 will still have what they call the 50% inclusion rate. So only 50% of that capital gain is taxable. After 250,000, under the proposed legislation, the gain, 2/3 of it will be taxable. And what that effectively does, by keeping 2/3 of it in income, it means the tax rate on a capital gain is going to go up. So it's roughly going to go up by about somewhere between, 5 or 6 points, but it really, in some provinces, 8 points. But it generally then means that person could go up by as much as 1/3. So when they pass away or they sell an asset and realize a capital gain, anything over the 250,000 for that year is going to be taxed at a much higher rate.
Okay. So does it mean different things? Okay. So what I heard in all of that, so depending on which province or territory you live in, it could mean different things in terms of how much more CRA could get. And on the other hand, I think my other question that comes up for me is how does that impact like a person's existing estate plan if they have life insurance?
Well, I think what it means is possibly if they were buying the life insurance for the purpose of funding the tax, they may need to revisit that because they may need additional insurance. But it also has implications on, particularly in any business owner, not just farmers, but all business owners, the importance of having the right structure so you can actually minimize your tax at death and realize things like the capital gains exemption and things like that. So basically the capital gains exemption allows for certain amounts of assets for shares or a farm property that qualifies to be exempt for the first $1.25 million of capital gain on it. So that's the increase in value of it. And in particular with, say, for farming and as well as fishing, the intergenerational rollover of farm assets or shares of a qualifying farm corporation, it's important that you meet the requirements so that you get that rollover if that's what, and if that's what they want. And by rollover, I should clarify, means that the transfer tax-free to the next generation. But again, there's certain requirements and certain way things should be set up to permit that, if it's possible.
Is there any questions that come up for you, Lacey, as you're listening in on this for yourself?
I just think it's really good conversation to be starting and having, especially like we're ranchers ourselves, but most of our clients are farmers or ranchers. And how can insurance be our friend rather than, the enemy, where a lot of times it's seen as an expense, but how can we be that comfort or, that soft place to land, and how do we introduce that and get that conversation to kind of try to change the tune of that conversation anytime insurance comes up. And so I just think, this is going to be really good information for our clients, because most of our clients, they're in the field, they're working with their hands to earn the money, right? And so I think it's really important for us to educate ourselves and to have those resources available, because they're not spending time in the tax book and figuring those things out. So I think, this is a good conversation. I'm excited.
Yeah, I mean, and if I could just add, I think it's really important to consider what the farmer or business owner wants, where they want it to go later on. I always get the talk of, I always get in the discussion where they say, well, we can qualify for that farm rollover. And sometimes they can't, but sometimes they can to the next generation. But often there are other assets that have capital gains on it, right? Or there might be another corporation or something. So the tax liability has to be covered before the next generation can take over in a lot of cases. But the other thing is, a lot of times, and I've seen this many times, and rightly so, that by far the biggest asset is the farm property, and the operations in that. And not every child of somebody is going to go into that, take over the business. There might be one child or two children that do it, but one or two might do something else. They might go off to school and go into another type of business activity or work for someone else or something along that lines. And the question then becomes, do you give that child part of the farm, or do you give them something else so that they don't feel like they're kind of left out? And that's where I find insurance plays a role in it. Because sometimes when you do see it go to someone who's not in the business, the other children, there can be a little bit of a resentment or disagreement on how things should be done between the person actually running the business and the person who's kind of like a passive investor at that point.
Definitely.
Yeah, definitely. Like we see that all the time. And even with our own family ranch here, it's been in the family for over 110 years. And so you don't want to see that broken up, right? You don't want to see the day come where it has to be sold or it has to be broken up. It's something that most families want to protect. And that's a really good point that you made. And we do say to our client, what do you want in the end when you're gone? What do you want? And sometimes we might have 2 kids, sometimes we might have 5 or 6. And so it's like ironing all of this out to where everybody wins. And most times where everybody wins, and the farm stays intact.
And so with that being said, like, for all of your years of experience, Bryan, in serving people from a legal capacity or just like in the working at the accounting office, level setting, like perhaps you could help level set expectations on number one, when is the best time to start? And there's sort of like, oh, there's only like a checklist of things to do and then you're done? Or is this sort of like something that needs to be an ongoing process?
Well, I mean, like everything, the sooner you start, the better, right? And really the goal should be provide as much flexibility to pivot and change a plan because people change and circumstances change and, kids get married and they marry people that people may or may not like. And that's another wrinkle that kind of gets thrown into the wrench on it. So really, I really like to see when we do the planning early, but with enough flexibility that we don't tie anybody to any decision, right? And I think that's probably the most important thing, and have revisit it quite a bit, right? And I'm not talking just from a life insurance standpoint. I'm talking from a planning standpoint, right? Revisit the wills of people. And, obviously people should have a will to dictate what they want to happen, but the ability to change it or have a corporate structure that allows for the ability to pivot if necessary. And again, it really does depend on the circumstances. And sometimes it just depends on the size of the farm or the assets that we're dealing with here as well, right? I mean, we don't want the legal or accounting fees taking a big chunk of the wealth, just right. So again, it's just one of those things where it depends on the circumstances.
Mm-hmm. So like on average, I'm just like from a curious standpoint, like, was it more of a rarity to see clients that sort of revisited their planning every single year, or was it just like only when life circumstances changed, or were more of the clients like people who didn't plan at all? you know?
Well, ideally it is. Yeah, there's a lot of not planning going on, unfortunately. And usually the planning gets initiated by the accountant. And if the accountant doesn't do it, then that's a bit of a problem, I would suggest. But again, then the accountant probably is well aware of circumstances when they change. But, I have seen the financial or insurance advisors be the one driving the process in many cases because they're the ones who hear about the changes in circumstances when someone says, yeah, my child got married and then, or somebody has a health issue or something along that lines. And that's when it does make a lot of sense to come in and revisit it. It doesn't mean a change has to be made. I've worked on quite a few plans where the flexibility is in the actual plan that a change like that doesn't change what happens. It just changes where we think it's going to go, but it doesn't change. There's a lot of flexibility to permit decisions to be made later to accommodate it.
So that totally makes sense. And circling back around to the, kind of like the original question around the impact of capital gains taxation, so we kind of circled around, okay, it's different from province to province, territory to territory. And what about if you're a sole proprietor versus, sole proprietor and partnership are sort of taxed the same, to my understanding. Please enlighten me or correct me if I'm wrong. And then there's corporations and then holding companies and then trusts. So does the capital gains taxation, is that different as a result of the way that any operation could be structured?
It generally doesn't have a lot of impact on the capital gain, other than if you realize a capital gain within a corporation, that gain is under the proposed rules, it's going to be all 2/3 of it is going to be taxable. There's no first 250 taxable at the 1/3 rate. And you're correct with a partnership, at least a general partnership, that any income earned in that partnership is allocated to the partners. So they get their own capital gain and all that type of thing. Now, where there is a difference and isn't the capital gains, it's the actual tax rate paid on the income earned in the business, right? And there's a very substantial difference on that. But from a capital gains perspective, not necessarily. I do think, though, from things like the capital gains exemption, there might be a difference in some circumstances, and we can touch on that if you want as well. But
definitely.
Go wherever you want to on this.
Well, I'm just doing my best, I don't know what everyone knows. There's a lot of farmers and ranchers out there who, have very tight relationships with their accountants. And so, perhaps there's some that understand how they're structured far more than others. I'm just doing my best to ask questions as if someone didn't know much about their situation and how, yeah, just to help, bring to light in case they never ask the question. Right. So there's other thoughts going on in my head around, okay, well, there's a lot of discussion too around the CDA account. And is there a correlation between the capital gains taxation and your CDA account, which is your capital dividend account? Yeah.
Yeah. So the capital dividend account is only available in a corporation. So when a corporation realizes a capital gain, the non-taxable portion of the capital gain, so in other words, 2/3 is taxable, 1/3 is not taxable. That 1/3 can then be paid out to a shareholder who's a Canadian resident and not be subject to tax as a capital dividend. Right. So the idea is that it just remains 2/3 taxable, 1/3 not taxable, whether you earn it in a corporation or personally. The capital dividend does play a role when we start talking about life insurance, because the insurance bought within a corporation, the death benefit on the life insurance policy minus something they call the adjusted cost basis gets added to the capital dividend account. So the life insurance can be flowed out to, again, Canadian resident shareholders as tax-free capital dividends.
Tax-free capital dividends.
Yes. Yeah.
Mm-hmm. Tax advantaged for sure.
You did ask about structures, and we can talk about structures and kind of get on the tax aspect of that if you want. But if you have another follow-up question to that other one, sorry for interrupting you there.
No, it's okay. I do want you to talk about that. Absolutely. But yes, structure would be good. Lacey, feel free to.
I just have one question regarding, so the CDA can be paid to a Canadian resident. So does that have a different impact if that Canadian resident has U.S. citizenship?
Yes.
I know that's a deep well.
No, do you know why I hesitate answering that? Only because it does create it's a difficult concept for people to gather, because once we start talking about U.S. citizens, there's so many things that are different, right? Because to begin with, and I should have mentioned this at the beginning, when I was at an accounting firm, I did cross-border tax planning, which meant tax planning for U.S. citizens here in Canada. And generally, U.S. citizens are subject to U.S. tax rules no matter where they live in the world. Yeah. So the fact that they're getting a capital dividend, and I know you probably knew the answer to this question when you asked it, but a capital dividend received by a U.S. citizen is not tax-free for U.S. purposes. It's a dividend. Right. There's also a bunch of other rules. The planning I hope to limit ourselves to today are for anyone who's not a U.S. citizen, because there's other rules too with corporations, as well as beneficiaries of trusts and things like that. And then there's also what they call the U.S. estate tax rules that apply. And
and I knew it was a deep well. I just wanted to, I guess, just because we do have a number of clients who do have dual citizenship, and one of them is myself, actually. And so I just wanted to say, okay, it is different, but that's a whole other ball.
Yes, it is. Yes, it is.
Yeah. Okay. Okay. So that answers my question. It is different when we're dealing with U.S. citizens, even though they're Canadian residents. So now we can move on. Yep.
Yeah, that's a good question to ask for sure. Maybe that's like a whole other. Yeah.
That's an episode in itself, or it's just, it's always at top of mind for me, because that is me. I'm a U.S. citizen as well. I'm a dual. So anyways.
Yeah. And there's different rules for when you start looking at if the kid is a U.S. citizen, if the parent lives in Canada, but the parent's a U.S. citizen, and there's so many different aspects of that where you really need to see an immigration lawyer who's versed in the U.S. rules to determine whether someone is actually a U.S. citizen.
Yes. We'll definitely put this one on park for right now.
Yeah, please.
Okay. Okay. So yeah, coming back around, yeah, please let us know about structures and what is a beneficial structure for agricultural operations to be in.
Yeah, again, it really depends on the circumstances, the size, and things like that. The advantage of, at least from a tax perspective, of being personally owned or in a general partnership is that when there's income or losses, they go into the individual's income, into their tax return. So in other words, if they have losses, they can write it off against other income if they have other income. The disadvantage of the partnership and the corporation is if it's profitable, the tax rate could be really high on it. And there's also liability exposure. So in other words, if there's a creditor of the business, if there's somebody gets injured on the property or whatever, the individuals, the liability could impact the individual to the extent they don't have some sort of general insurance coverage or the coverage gets exhausted, right? So for a lot of operations, and probably 99% of the clients I deal with, they're using a corporation to conduct their business. One, for the liability protection. In other words, assuming the bank doesn't have a personal guarantee on the individual, the liability is limited to the assets in that corporation. The other aspect is, and this is where the tax system plays a huge role, is that business income, so, income from the farming or ranching operations, is what they call active business income. And it gets a much more favorable tax rate. And so, if I'm talking about Alberta, that tax rate is, I'm looking it up right now. So the tax rate could be as low as 11% on the first 500,000. And then after that 500,000, it only jumps to 23%. Right? Whereas if the individual owned it, that same income could be taxed as high as 48%. Right? So there's a huge tax hit on earning the business income personally if the person's in the top tax bracket.
Mm-hmm.
So usually when an operation gets large enough, the consideration becomes maybe we should transfer it to the corporation. And everything other than inventory can basically be transferred over tax-free with some of the tax elections that are available under the Income Tax Act. So, converting to a corporation isn't a big deal in a lot of cases.
Right. So if you're like a sole proprietor or in partnership, right, and you had $2 million worth of equipment and, the property that you're on and the land is worth, 2.5 million, you could transfer that into a corporation tax-free.
Correct.
Okay. So would you, for assets, would you keep it inside a corporation or are there any benefits of having it in a holding company?
Well, holding company is a corporation, right? So generally, but you're asking whether they should also have a holding company? Is that?
Well, my understanding, I guess, has always been like a corporation. Yes, Holdco is like a corporation for sure. But with a holding company, I've always thought that's not where you have your active income. That's where you have your assets. And
you have your assets that aren't used in the business, holding company in a lot of cases, right?
Right.
And there are structures that permit when a business earns income, the excess income that's not required the excess cash flow that's not required in the business could be paid out to the corporation, the holding company. And there's various ways that can be done and structures in place for that. Every now and then I do see a separation between the land that's used in the business and the business assets, the operational assets. Again, that's for creditor protection. So if there's some liability associated with the operations, they don't take the land. Right. And the other way around. Right. So, and it also facilitates a possibility of just selling the operations or just selling the land at a future date too. Right.
Right.
Because again, things change and people acquire land, people sell land. But usually things like the quota and the other business, the other equipment and stuff might be in another corporation, but it's still Both of them are generating business income when
Mhm.
they're using the operation, but it's just a way of structuring it.
Sorry, did you say that you would have like for all of our dairy farmers out there, the quota should be held inside the holding company? Is that what I just heard you say?
No, sorry. I
Oh,
just said no, it should be with the operations.
should be with the
Yeah.
operations. The
Right.
operating.
And the land would be in a company, but not necessarily the holding company. Right. Because again, you want to keep the business assets, which land really is a business asset in these cases because it's used by the business. You want to keep them separate from your passive assets, including if there's any corporate owned life insurance policies. You'd want that in the holding company, and so anything you're not going to sell should be in the holding company.
That's what I was going to
Right.
ask you. And you said the holding company should hold assets that aren't used in the business. And so, can you give our listeners an example? So, one would be life insurance. What would be?
One would be a portfolio investment. So like if they're diversifying and buying stocks, bonds, mutual funds, segregated funds, whatever, or even if they're buying a rental property, like a rent. So in other words, again, a rental property, I might have that in a separate company from the holding company. If there's a liability for liability reasons, again, it really depends on how values and how much people are concerned about the liability in those assets in that area.
But you wouldn't put land that you don't want to sell. Because you said nothing that you don't want to sell should be in the holding company.
Okay, yeah, I probably should correct myself. No, sometimes I will have land that I don't want to sell. What I meant is what I don't want to sell is part of the business. I should have clarified that. Anything I don't want to sell is part of the business, being the farm, the ranch, or if they're in another business, right? I have found there's a lot of, at least within the farming community, there's a lot of people who are not just in the farming business, there also might be in like mechanical repair type business or something like that and things like that. So I find that then you want to keep everything in separate corps, and they might somehow be linked to the holding company. And I keep saying things like linked to the holding company because I don't want all the shares of anything where I can get a capital gains exemption owned by a holding company if I can avoid it. And the reason I say that is because of the capital gains exemption.
Mm-hmm.
Right? If I want to get the capital gains exemption or the rollover of shares of a farm corporation, those are only available to shares that are owned by an individual. Right? So I don't want, that's why I always come back to the key that structure is really important, especially as the operations get more diverse and more significant in value. Because if you have too many of the non-farm assets in the same corporation, you could lose the capital gains exemption and the farm rollover. But you could also, and if you have the holding company owning all the shares, or you lose the rollover on that portion of the corporation, of the farm corporation, right? So I generally, and it does make things a lot more complex. I'm not going to pretend that it doesn't. And CRA is always closing opportunities to do it ways where it makes sense from a logical standpoint, but they say you can't do that because we know you're trying to avoid capital gains tax.
Oh, you can't do that because it'll take money away from us.
Yeah.
Did I say that out loud?
Yeah.
Damn it.
Would you mind speaking to the rollover? So, like so many of our clients, the rollover is a huge part of their planning. So maybe they're rolling over to children, but maybe it's not children they're rolling over to. Maybe it's just another family member. So can you speak to what's important to know about the rollover?
Yeah. Okay. I mean, so just to be clear, so everyone is, because I do understand the rollover term doesn't necessarily, unless you know what a rollover is, you don't understand it. The rollover is the idea that you can transfer something over to another person at its cost base, so there's no tax triggered on it, and the person who gets it inherits that tax break. So there's rollovers in really a very few situations. The number one situation is you can roll over to your spouse anytime, right? You can transfer assets to your spouse or common law partner at any point in time for assets like what we call capital assets, assets that generate income and things like that. You can transfer that anything that you own directly to your spouse. Now, if the spouse earns income on it while you're alive, there's what they call attribution rules. So you're still going to pay tax on that income. Right. So rolling it over to my spouse really doesn't help me from a tax perspective. Unless my spouse pays fair market value for it, then I don't get the rollover because then I have a capital gain. Right. So that's number one. Number two, the other cases is for spouse and that's applicable to farm property and the shares of the farm corporation that qualify. It can roll over to a child. And I believe, sorry, I should have probably thought about looking this up before we got on. I believe child also includes grandchild. I think the definition in the income tax generally usually says child includes grandchild, but some provisions it doesn't, some it does. So I'd have to double check on that one, to be honest with you. So I don't want to mislead it.
So it may include grandchildren.
Yeah. And like everything I say, people should confirm this with their tax advisors. I don't feel like getting into a lawsuit on things that I say on the podcast. But the other thing is really the rules for the rollover are very precise. And, that the assets got to be used in farming and principally in farming and things like that. And the tests are very, very detailed and very asset based. In the sense that, how much, if it's shares of a company, how much can there be non-farm assets in that corporation? It's very limited. And it's really something they do need to discuss with their accountant, because if they don't qualify now, they should probably do some action to move those non-business assets out of that corporation before it's too late to do it. Right? Once you've passed away, you can't change what was in the corporation when you pass away. You obviously, if you're going to gift it to a kid, and you can gift it to the kid when you die or during life, and then you can, during life, you can obviously get the assets out to qualify. But again, someone should check that before the transfer actually occurs.
Yeah, I think the theme that keeps coming up in my head is like, yes, the sooner that you start planning and strategizing, the less it will cost you.
Yeah.
That is like the thing. Like, I think if people don't and they wait till the very end, they're literally costing themselves so much money otherwise.
And I've had that problem where it became a dilemma for them in the sense that they decided to buy a rental property in the corporation that's conducting the business. And, from a liability standpoint, it wasn't a great decision, but also from the decision standpoint, that rental property is a passive asset and therefore would mess up the capital gains exemption in the case I was discussing. And in the case I was just talking about, they're actually selling the business to somebody else. And basically we told them, you have to move this before the sale. And that means moving it, when you move it, you move it out to a shareholder or to somebody else, you're triggering the capital gain on it. So, and as everyone knows, land values have gone up and rental properties have gone way up in value. So they were looking at a huge tax liability. And had they structured this properly before, they wouldn't have had to pay that tax liability to get it out of the corporation because it would have been somewhere else initially.
So going back over to the rollover, just like capital gains, does the rollover rules change from province to province and territory to territory? Is that also different too?
No, I will talk about everything but Quebec. Because Quebec has its own tax act for individuals, right? For the provinces and the territories are governed by the Federal Income Tax Act, and then the province has its own, modification, but they pretty much piggyback on the federal government for it. So the rules are
different
everywhere, pretty much the same. There's some small tweaks on the corporate side for each province from the Federal Income Tax Act, but nothing substantial in this area.
What about the rollover? Is the rollover rules, they're all applicable, whether you're a sole proprietor, partnership, or holding company, trusts? That's all the same as well.
So the rollover rules apply to transferring assets to a corporation or to a spouse or to a child if it's farm property. The trust has its own rules. Trusts are a different creature. They're taxed like an individual, but generally there are, other than if it's an estate, in a special type of estate, they don't get graduated tax rate. Everything's taxed at the highest tax rate. And you can roll assets, most assets out of a trust to an individual who's a capital beneficiary of the trust. So the beneficiary is the person the trust is holding the asset on behalf of. And basically it can roll out to a Canadian resident on a tax-free basis that way too. But you generally, other than certain trusts, you can't transfer assets into on a tax-free basis. There's no rollover.
Certain trusts. Does certain trust have a name?
So generally, so you can transfer to what they call an alter ego trust, which is a trust that you set up for yourself when you're over 65. And it has to meet certain requirements. You can only be the beneficiary of that trust while you're alive, and nobody else can get any of those assets of that trust, including the income on that trust while you're alive. And you have to receive all the income from that trust or be entitled to it. The other one is a spousal trust. So I don't have to be 65. I could set up a trust to hold assets for my spouse while I'm alive. And the same idea is she'd be entitled to all the income from the trust. And she could get access to the capital if the trustees decide she should, if the trustees agree to distribute capital, if it's a discretionary trust, but no one else can until she's passed away. And the other type is one that's, I'm over 65 and it's for both me and my spouse. Same type of setup there. So with those trusts though, any assets that are in that trust when I die, if it's an alter ego trust, or when my spouse dies, if it's a spousal trust, those assets are deemed to be sold at fair market value when someone passes away. There's limited, there's no really tax savings from doing that because, when that person dies, the capital gain is still triggered.
Mm-hmm. Yeah. So, yeah, more and more, like I know CRA has really stripped any beneficial tax privileges from trusts. So really the only reason why most people are actually considering it is more or less control over circumstances or something, right? Like is not like general conceptually speaking without getting too much in the weeds.
Yeah. Well, in a lot of cases, yes, it is used as a tax vehicle in a corporate setting. In other words, having a trust own shares of a corporation pursuant to a reorganization called an estate freeze, where the idea is to then transfer all future growth to another generation or to other people and possibly, and we could get really in the weeds on that, but possibly realize capital gains in that trust and allocate them to individuals who are family, who are beneficiaries of that trust to get more than one capital gains exemption. And I'll be honest, a lot of the planning I'm involved with involves doing that exactly.
Interesting. So
but control is a big factor too, though, right? And people use trust for other purposes as well.
Like for example, like I guess a piece of control would be like one of the things that I can see is more like maybe controlling who can get what. Like so, like if there was like someone who wants it really just to stay within the family, like their immediate family, but doesn't want their spouse, like the spouse that's outside of the family, to have any sort of access, in case of divorce, or maybe they just don't like that individual, or maybe it's like, you know what I mean? Like, so it's like, basically, I think in my mind, a trust has been used to like keep certain people out, right?
Well, it's questionable how effective it is in some cases. In the sense of a spouse, like, if there's a divorce, the spouse gets some of the assets, right? They may or may not get the assets of the trust. Generally, the thought is they shouldn't get the asset if it's what we call a discretionary trust. That being said, and I always hesitate to say this, but we never know what a family law court would decide on a divorce.
Mm-hmm.
We're not, unfortunately, we'd love it if they respected the independence of the trust and the trustees, but we're never positive that's going to happen. The one thing I should point out for most trusts and the trust for these purposes, these trusts are subject to what they call a deemed disposition rule every 21 years. And then so what that means is on the 21st anniversary of that trust, it's deemed to sell its assets at fair market, certain assets. And for example, shares of a company, investment assets. And the one exclusion we can revisit that is a life insurance policy. It is not deemed disposed of on the 21st anniversary. So what happens with that is that usually at that point, right before that 21st anniversary, well before hopefully they're talking about it and thinking about it, they decide they can distribute those assets out of that trust on a tax-free basis to capital beneficiaries of that trust who are residents of Canada. That way, the gain is not triggered on that 21st anniversary because the trust doesn't own that asset.
I noticed you used the word.
That's all part of the planning.
Mm-hmm. I noticed you used the word Canadian resident. So Canadian citizen is not like, it's just someone who lives in Canada. They don't even have to have citizenship. Okay.
No. Again, if we come back to U.S. citizens, there might be different U.S. tax rules that impact that transfer out. While there's usually different rules that impact the ability to actually own the can own assets in a non-U.S. trust for U.S. citizens. So there's different tax rules there as well. Yeah. But again, that's well beyond what we want to get into on that.
So while we're on the subject of trust, and I know that most people have heard the word trust, but they don't really even know what it is. So if we're meeting with clients, they're in the beginning stages, and like, when should they consider a trust or when should they not? Because I know a lot of our clients, they don't even know what it is.
Yeah. So to begin with, the trust is really a contractual relationship between the person who creates that trust. And if it's a trust created when you're alive, the person's called the settlor. And usually your clients are not the settlor of the trust. I'm going to kind of be very clear on that because there's certain tax rules. And the trustees are people who manage the assets of the trust and make the decisions for the trust with respect to the assets that it's holding for the benefit of the people we call beneficiaries. And there's, beneficiaries can be capital beneficiaries or income beneficiaries. Usually most of the beneficiaries are both in the planning context we're talking about. Right. So if we're talking about your client, if this is set up properly, and CRA does check these things that they are set up properly. And I always warn people, don't cut corners on how this is being done and also how the trust is buying the shares of the company and things like that if we're doing it in that context. But we usually have your client's spouse, particularly if it's a first marriage, and the client's children and possibly future grandchildren and things like that. So not everyone has to be alive at the time it's created as beneficiaries of that trust. And the trustees then, and these are usually what we call discretionary trusts. So the trustees can decide who gets what and who distribute, who, when, under what, in accordance with the terms of the trust, when they can distribute assets and things like that, and income earned by the trust. So, it sounds very complex, and usually in the cases we're dealing with, the client is usually one of the trustees of the trust and probably the client's spouse. And then maybe I recommend a third party to break any ties because surprise, spouses don't always agree on everything. I think it's very important that we allow for that possibility and we don't have a spouse that's paralyzed by spouses not agreeing on something.
Right. Okay, so I am your client. I come to you. I'm married. I have 3 kids. Why should I set up a trust?
And you're not a U.S. citizen in my example.
And I'm not a U.S. citizen. Why should I?
Yes.
So my husband comes to you. Yeah. We're married. We have 3 kids. Why should we set up a trust? Or, just any client.
Yeah. So if the client's not, if none of the client or their spouse or kids are not U.S. citizen, the reason we consider that is for a variety of reasons. So we usually do it in the context of what we call an estate freeze. So we end up freezing, in your case, the ranch corporation, right? And so in other words, let's just say the ranch is worth, and I have no knowledge of your ranch, so I'm going to say $5 million. I don't know if so if that's the value, you freeze the value at that. And generally, if that's a value you and your spouse are satisfied with having the $5 million of value, then they should consider it. If the value is only $200,000 or $300,000, you're probably going to say this is way too early to do a freeze, right? So then I'm not going to do the trust in that instance, in all likelihood. There might be other reasons, but I'm just kind of being general case. So you then take back shares that are worth $5 million. The idea of the trust was the trust could then get all future growth in the value of the shares. And what that allows for is it freezes your tax liability on your shares as long as but that aspect of your assets. Obviously, anything else you own, if you own a holding company, that is still exposed to increases in values in this context, unless we do something similar there, which is a whole different game plan. But so then if the company goes up in value, and let's just say, 20 years or 15 years from now, it's worth 20 million. If you sell the shares, your shares have the $5 million gain. The trust shares have the $15 million gain. That gain could be allocated by the trustees, the taxable portion of that gain. So 2/3 of, I actually made numbers that work, two easy numbers that work. So 2/3 of that 15 million gain, so 10 million, those taxable gains could be allocated to the beneficiaries of the trust so that they can use their capital gains exemption, provided the shares qualify. So, but it also provides a way to freeze your tax liability if you don't want to, and then so when you and your spouse die, so that the taxes crystallize and the kids inherit the future tax liability, but they're going to potentially die much later. And in addition, the trust says, if you decide one kid's going to take over that business, then the trust can give the shares just to that kid if it hasn't been sold, right? And it's a very quick way to do it and an easier way to deal with it. But it provides the flexibility. Now you don't have to decide which kid's going to get it by having the trust, right? Because your kids are probably pretty young, so you probably you haven't made a decision which ones are going to be in the business, because some might have different interests or not want to.
Yeah, that's right. Yeah. And I think, just from our client's perspective, like asking these questions is great because most people have heard of trust but they don't really know what they involved or even maybe what they're used for. So this is a conversation where their accountant would play a huge role, correct?
Absolutely. Yes.